Good morning, good afternoon, and good evening to you all, and welcome to today's ISTAT Learning Lab, where we're going to learn all about aviation insurance. My name is Peter Negline. I am the CEO and founder of Macrolytics based in Melbourne, Australia, and I'm a member of the board of directors of ISTAT. Now, before I introduce today's speaker, I just wanted to take a moment to emphasize ISTAT's mission regarding education within the aviation industry. And I recently was able to attend ISTAT's conference in London and at a mentoring session that was organised by the ISTAT Foundation. A student there told me that she was doing a master's degree in aviation finance and that her professors and lecturers regularly recommended these ISTAT learning labs as a key source of knowledge for the students. So please keep in mind some of these learning labs are around topical issues, but some of them are also around foundational matters that are very important to students and to the young professionals entering our industry. And of course, we want everybody to be versed in all the major topics, and aviation is one of those. Now, it's my great pleasure to introduce a former colleague, Andrea Wilson, who is the CEO and founder of Wilson Consulting Group. Andrea is going to provide us not only with an overview of aviation insurance, but also how the market works, the various types of coverage, and how that relates and matters that are important for lessors, owners, and financiers of aircraft. Now, Andrea was a colleague of mine for 7 years at BOC Aviation. I was based in Singapore, but Andrea is based in Dublin. She was the VP, I should say, and head of insurance. And prior to that, she held a similar position at DAE, also in Dublin, for 5 years. She is a certified insurance practitioner with the Insurance Institute of Ireland, and she has an honours degree in business studies from Trinity College, Dublin. Now, before I hand things over to Andrea, just some housekeeping matters. Please add your question to the Q&A button that's in the middle of the screen on the bottom. You'll see there. The session will be recorded and available on demand from the ISTAT website, which is istat.org. That'll be available in the next 24 hours or so. Please encourage all of your friends and contacts to check out the extensive library that we've developed and it's available for you on the ISTAT website. I'll come back with Q&A for the Q&A session after Andrea's presentation. But please, I reinforce the point: don't delay to get your questions in there. Andrea has a limited time beyond the hour, so we want to make sure we wrap that up as quickly as possible. So, Andrea, a very warm welcome to you, and I'll hand things over for your presentation. Thank you.
Thank you, Peter. Can you just maybe give me a nod to make sure that you can hear me? And
we can hear you fine.
Presentation?
Yep, it's all good. Thank you very much.
Super. Hello, everyone. You're all very welcome to today's ISTAT Learning Lab on the topic of aviation insurance consideration for aircraft owners, lessors, and financiers. My goal today is to take an intricate subject and break it down so that you understand the main areas of concern for lessors, financiers, and owners when it comes to insurance for commercial aircraft. A little about me before we get started. As Peter's already done half of my introduction, I won't go over this in too much detail. My name is Andrea Wilson. I'm CEO of Wilson Consulting Group. Before I started in leasing, I held various roles across different industries, such as motor, COSEC, and IT, where I was mainly running back office operations for startups. I started in the aviation industry in 2010, spending 5 years in the insurance team at AWAS, now a part of DAE Capital. And while I was there in 2012, as Peter mentioned, I have obtained my qualification with the Insurance Institute of Ireland. So I am a certified insurance practitioner. My last in-house role was at BOC Aviation, working with Peter. I joined in 2015 and established the insurance function there. I handled all insurance-related activity across the company, being transaction, input, and advice in respect of insurance for sales, LOIs, PLBs, deliveries, GTAs, property leases, etc. And also insurance procurement for the aviation, directors and officers liability, and various non-aviation policies. It also included managing requests for proposal processes for brokers and lead underwriters. During my 7-year tenure, there was 2 ABS transactions and the fleet grew from 250 to 425 aircraft. So with that 12 years of in-house experience, I started Wilson Consulting Group in January 2023 to provide insurance training and consulting to aircraft lessors. Just to give you some examples of the types of projects I've completed since inception in January: one-on-one training for insurance staff in a top 5 global lessor, bespoke training for a contracts management team in an aircraft asset manager, seminars for leasing companies and CPD hours for a legal firm on recent changes since the Russian sanctions and litigation, transaction review and input for companies of various sizes, effectively acting as an outsourced insurance function, assistance for leasing companies with their aviation and directors and officers liability insurance renewals, and the auditing of insurance compliance. This involves a review of the insurance terms required by leasing and financing documents and a comparison of the corresponding cover evidenced by insurance and reinsurance certificates. Here is the outline of what I will discuss today. First, we will set the scene and talk very briefly about what insurance is, then drilling down to look at what aviation insurance is and how it fits into leasing and the aircraft life cycle. We will then look at how insurance markets function, and we will delve into the types of aviation insurance cover that are relevant to owners, lessors, and financiers. I will touch on AVN 67B, lessor insurance, and the concept of negligent entrustment. And finally, we will discuss recent changes in the market from various events over the last few years, such as Russia's invasion of Ukraine, the subsequent sanctions imposed, and other more recent geopolitical events that have impacted market conditions, cover, and rates. At the end, we should have some time for Q&A. Please, as Peter said, submit your questions through the Q&A button, and I will try to answer as many as I can. Please note, I cannot answer any questions relating to claims and the corresponding litigation surrounding the aircraft in Russia. I'm hopeful that we will get your questions answered before the hour mark, and then I will have to, unfortunately, have a hard stop. So what is insurance? Despite being very enthusiastic about the subject myself, I am aware that not everybody feels the same way. And a lot of the time when I introduce myself as working in insurance, I can see people's eyes glaze over. So we won't go into too much detail when it comes to insurance. The simplest definition of insurance is a promise to pay. It is a risk transfer tool, and it relies on the premiums of the many paying the losses of the few. Let's say you're like me and you're a big fan of Lada cars. This is my favorite model. This is the Lada Niva. And you save up and you buy yourself one as a treat. When you own a car, you bear the risk of loss or the risk of damage to the car. This means if your beloved Lada got damaged, you would want to repair it, or if it was beyond repair, you would want the current market value so you could replace it. Insurance on your Lada will put you back in the position you were in and repair it or replace it under the principle of indemnity. There are other risks associated with driving the car, aside from looking incredibly cool, of course: the risk of damage to third-party property and the risk of third-party bodily injury. These risks can also be covered by motor insurance and are compulsory in a number of countries. I may not be able to convince anyone of how interesting, varied, and exciting the insurance world can be, but once we add in aircraft, I think I have a better chance. So moving on from cars to look more specifically at aircraft. When it comes to owning and financing aircraft, there will be a similar desire to protect your asset and make sure that any damage caused to it or that it causes to others or their property is covered by insurance. Our main types of cover are the hull all risks and hull war policies that cover the aircraft itself, and the liability and excess war third-party liability covers which cover property damage and bodily injury to others. I will discuss the cover types in more detail at a later stage of the presentation. In terms of compulsory insurance, various entities will require proof of insurance from operators before they can fly, such as airports, aviation authorities, and aircraft registers. The levels of this compulsory insurance will vary across jurisdictions and between entities. This means that insurance is one of the first costs an airline will incur on startup and one of the very last things they will stop paying in a distress situation. One way that aviation insurance differs from other types is that aircraft hull values are presented as agreed values. An agreed value policy is one where the insured value for the asset is agreed in advance between the insured and the underwriters for the term of the policy, usually on a declaration of values, and premiums are paid based on that agreed value. You will note the use of the term hull, which points to the origins of aviation insurance in the marine insurance market. Now let's look at how insurance touches on all stages of the aircraft life cycle. So starting at the top at aircraft delivery. Insurance is a condition precedent for an aircraft delivery, which means it must be reviewed, approved, and signed off on before an aircraft can be delivered under lease. Moving to lease management. Once the lease has commenced, there will be the annual fleet renewal process for the airline. Airline insurances are almost all placed on a 12-month basis and fleet-wide. This can lead to an onerous administrative exercise for the airline, their broker, and the leasing function handling renewed certificates. 70% of the world's fleet is renewed in the last quarter of the year. And on the 30th of November, I would have typically received 250 to 300 insurance documents between certificates, addenda, master certificates, engine gross-up certificates, insurance, reinsurance, second and third reinsurance certificates, letters of undertaking, etc. Besides the admin-heavy renewals, during the life of the lease, there may also be various structural changes to the leasing or financing, refinancing, novations, or various amendments to the lease that the insurance function may be required to review. The insurance team may also need to assist with the claims process for partial or total losses. I've added lease end as the next stage, but we can also consider a sale with the lease attached or a repossession to fall into this category. Each of these scenarios will require run-off certificates. Run-off cover is required for the past ownership, leasing, or financing of an aircraft. If there is an incident related to an aircraft that is traced back to the prior ownership, leasing, or financing, then protection is required and provided under products liability insurance. The typical duration will be for 2 years or until the next major airframe check, whichever is earliest. The example commonly used to illustrate this is where a lessee has the check performed before the end of the lease and a spanner is left in an engine. If the aircraft crashes and the cause of that crash is traced back to the spanner being left behind during the time that the lessor was leasing to the lessee, it is entirely possible that the lessor could be named in the litigation for third-party property damage and/or bodily injury. As a wise broker once told me, you don't have to be guilty to be sued. As I mentioned, there is usually a 2-year time frame or until the next major airframe check, whichever is earlier. The assumption is that any major issues should be either come to light within that 2-year time frame or would be rectified within the next major airframe check. This cover is interchangeably known as run-off cover, ongoing liability, tail liability, or trailing liability. It is important to note that it is harder to get this cover in the event of a repossession where the airline has gone bankrupt, because this cover is on a claims made basis rather than a claims arising basis. This means it needs to continue to be purchased in order to remain in effect and valid. So moving to the next step in the cycle and to origination. When a new or used aircraft is being put onto the market for leasing, the letter of intent, or LOI as it is commonly referred to, will include various insurance values and terms, and the insurance team should be involved in drafting. At this stage, for a new airline customer, it will be prudent to perform due diligence on their insurance structure. The insurance team may also need to get involved in the drafting and negotiation of the lease and any applicable financing or other relevant transaction documents. Zooming back out to look at the wider insurance market as a whole, we will look at how these markets function, in particular the concept of a hard and soft market. If we start up at the top center, moving clockwise, we will see that when profits are good, this will lead to new capital flooding into the market, and the capacity for insurance buyers expands. This then leads to increased competition as underwriters fight for share. Then either losses will start to occur in the market, or competition heats up, or the combination of losses and competition will lead to rates dropping. This is what we call the soft market. Once the rates have dropped, capacity starts to leave the market, being of the view that losses are too high or rates are too low, or possibly both. As capacity leaves and potentially the losses have started to crystallize, rates will increase and, in due course, profits will increase. This is what we call a hard market. There was a soft market in aviation from about 2008 to 2019. It's been a long-held belief that the hull war market in particular was consistently underpriced during this period, with premiums unable to keep pace with losses. To help illustrate this point, annual hull war premiums during this timeframe ran in the region of $70 to $80 million per annum. In the summer of 2014, about 20 commercial aircraft and a number of military aircraft were damaged or lost at Tripoli Airport as a result of a battle between rival militias. Losses were estimated at $300 million, so that was more than 3 years' premiums wiped out in one single day. This photograph on screen is from Tripoli Airport on the 25th of July 2014, after the incident I mentioned, and it shows 21 aircraft that have been identified by Aviation Safety Network, with the 2 in orange completely obliterated. Aviation Safety Network is a great source of information on aircraft damage and losses for those that are interested. Jumping forward about a decade to the 2022 Russian invasion of Ukraine, the hull war market hardened and rates went up dramatically, especially for aircraft lessors. As a result, the hull war premium pot increased to approximately $350 million in 2022, and the hull war premium levels would have been expected to be in or about the same level of $350 million for 2023. Once again, unforeseen events had a devastating effect on the market, this time with the outbreak of fighting at Khartoum International Airport in Sudan in April 2023. More than 20 planes and helicopters are reported to have been destroyed or damaged, including a number of total losses, which can be seen in the photograph here. The last loss estimate that I saw for this event was 240 to 300 million US dollars. So this one event has again almost entirely wiped out premiums for the year at the upper end of this worst case loss estimate. Hull war underwriters will have adjusted rates throughout the year since April to recoup their losses, which will mean the persistence of the hard market. Before we move on to talk about the different types of cover, it's worth looking at how a typical aviation insurance policy is put together. The aviation insurance market is still quite traditional in many ways, one of which being that you need a broker to access the market. The first step is that an airline or lessor will put together information on their fleet and growth and various other data points for underwriters and provide this to their broker. The broker will then bring this to the insurance market and start a competitive process to put the insurance program together. What you see here on screen is a very rudimentary representation of how a program is built. There will be a leader at the top of the chain. They usually charge a higher rate and or a leader's fee, as they will have claim speciality in-house and take the burden of higher costs as a result. The following markets will then take a share of the program at various differentials off the leader's price. The broker will continue to generate offers of shares until they hopefully are in excess of 100%, which allows them to toggle the best offers and put the most competitive rates together. This process is called vertical marketing. Over a number of weeks, the broker will intensively market the risk, bringing it to the underwriters of choice. The insurance market, as mentioned, remains very traditional. This means there is still a very heavy reliance on physically presenting risks on paper for an underwriter to sign a line and present their stamp. Less so than before COVID, when underwriters really did need to catch up with the digital times. I want to highlight here that in a soft market, the following market always writes a differential below the leader on the program, as per this example. However, in a hard market, it is entirely possible for a following market to write at terms above the leaders. Moving on to look at the different cover types, we will start with the property insurance. An all risks policy, as the name indicates, will provide cover for physical loss or damage caused by all risks, unless specifically excluded under the policy. The main exclusions will be mechanical breakdown and wear and tear. War-related risks are excluded with the AVN 48B clause, and nuclear risks are excluded with the AVN 38B clause. Loss of use is excluded as this is seen as a consequential loss rather than a direct one. Airlines can obtain cover separately for this. Ingestion and foreign object damage unless caused by a single recorded incident. The key thing would be that the incident in question was recorded in the engine log and the engine was immediately withdrawn from service. And if that is the case, that single recorded incident would be covered by hull all risks cover. Losses under hull all risks will be either total or partial. For total losses, the aircraft will either be beyond economic repair, or BER as it's referred to, or it will be an agreed, constructive or arranged total loss between the insurers and the insured. Airline policies will contain the concept of a constructive total loss threshold. The policy will specify this constructive total loss threshold, and it is usually set at around 75 to 80% of the agreed value. If there is major damage incurred on the aircraft, but it is not an outright total loss, and the cost of repairing the damage reaches this constructive total loss threshold of, say, 75 or 80%, then the aircraft will be declared a constructive total loss. So if we had an aircraft with an agreed value of, say, $50 million and a constructive total loss threshold of 75%, then damage that would cost in excess of $37.5 million to repair will mean that the aircraft is a constructive total loss, and insurers will pay the full agreed value for that and take the salvage. So if there is any value left in an aircraft, airframe or engines after a total loss, and insurers have paid the agreed value, they are then entitled to the salvage, and title will be transferred to them. Hull all risks deductibles are applicable to partial losses. They operate like an excess on your motor insurance policy, and the airline will be responsible for paying these deductibles in the event of a partial loss. You will see here the standard market deductibles from the insurance market. These are the insurance market terms. Hence, hybrid is what we in leasing would classify as narrow-bodied, larger single-aisle twin-engine jets. And narrow-bodied here is what we would classify in leasing as smaller regional jets, turboprops, etc. Looking at the photograph that I've used here to illustrate a hull all risks incident. This is from Palma Airport on the 19th of September 2023. An Air Europa aircraft coming from Barcelona was arriving at the terminal and collided with the rear of a stationary Condor aircraft waiting for permission to taxi. I would expect this damage to be covered by a hull all risks policy. Hull war cover will seek to add back the cover excluded by AVN 48B under the hull all risks policy, other than paragraph B, which relates to the hostile detonation of a nuclear device. It will cover war, invasion, civil war, rebellion, revolution, military coup, strikes, riots, civil commotion, acts for political or terrorist purposes, malicious acts, confiscation and the requisition of aircraft, and hijacking. LSW is short for Lloyd's Standard Wording, and LSW 555D is the accepted aviation hull war and allied perils policy wording that is the generally accepted standard in the market currently. Hull war policies will almost always be subject to an aggregate limit. An aggregate limit is a specified maximum sum that will be payable in respect of any or all claims made in connection with the events occurring during the policy period. The old way of calculating aggregate limits for an airline fleet was 3 times the maximum aircraft value, or the aggregate of the top 3 valued aircraft in an airline's fleet. But with coverage creep, this has increased over the years as an add-on under many airline policies and would not necessarily have had a direct link to the agreed value schedule for the fleet. Hull war is also on an agreed value basis, and there are no deductibles applicable under a hull war policy. There is an automatic exclusion for war between any 2 of the 5 great powers, being the USA, UK, France, the Russian Federation, and China. There is no cover for nuclear detonations. Photo used to illustrate hull war is from Tripoli Airport in July 2014, which is the incident I was referring to earlier, in which about 20 commercial aircraft and a number of military aircraft were damaged or lost after a battle between rival militias. This was a Libyan Air Force Ilyushin 76 transport aircraft that was struck by RPG fire and consumed by fire. Looking at cover for spares, the first thing we need to ask is, when is a spare a spare? The standard definition of an aircraft under the insurance policy is the hull, machinery, instruments, and the entire equipment of the aircraft, including parts removed but not replaced. Ergo, once a part is replaced, it is no longer a part of the aircraft and becomes a spare. Conversely, once a part is installed on an aircraft, it is no longer a spare. Insurance policies will usually outline the exact point at which a spare becomes a spare, something to the effect of, until the moment such part is safely in contact with the ground or the trolley or stand on which it is to be located when the process of removing it from the aircraft is complete and it is totally disconnected from the aircraft. The all risks cover for spares will be on the same basis as that for the aircraft and cover spares in storage or in transit. Spares are typically insured on a replacement value basis and subject to limits such as any one occurrence, any one item, any one location, and also subject to deductibles. There is no market standard deductible for spares as there is for aircraft, but it is commonly set at $10,000 each claim. In the case of engine running or testing losses, the aircraft deductible will apply. War cover for spares will be on the same basis as the aircraft hull war policy. Legal liability coverage will then indemnify against legal liability for bodily injury or property damage suffered by third parties, including passengers, baggage, and cargo, arising from the aviation operations of the airline and caused by an occurrence. An occurrence is an accident, happening, or event, or a continuous or repeated exposure to conditions occurring during the period of the policy, which results in bodily injury and/or property damage, neither expected nor intended from the standpoint of the insured. The reason I have added the picture here is that coffee spills are typically the most common type of liability claim that airlines have to deal with. And under the Montreal Convention, airlines have strict liability for any accidents on board, which would include this type of accident. There's also been an increase in claims relating to objects falling from overhead bins in recent years. Most of the exclusions under legal liability are self-explanatory. There'll be an exclusion for non-aviation risk, such as those covered by employer's liability or a motor policy. There will be an exclusion for damage to the property of the insured, as the legal liability is intended to cover third-party risks, and the insured should cover their property under their own property policy. Noise, pollution, contamination, and electrical interference are excluded by clause AVN 46B. Nuclear risks remain outside the remit of aviation insurance coverage. You will note that war and allied perils are excluded. However, these are separately added back, and I will explain this on the next slide. Then liability assumed under contract and liability arising from criminal acts, financial default, etc. are excluded. And finally, product defect rectification is excluded, as this should be more appropriately insured under a product's liability policy. On the last slide, we saw how war-related liability risks were excluded by AVN 48B. Clause AVN 52E then writes back all subparagraphs of AVN 48B, with the exception of paragraph B, dealing with nuclear detonations. The war between two of the major five powers remains an automatic exclusion as well under AVN 52E. This third-party war liability coverage under AVN 52E is limited to $150 to $250 million each occurrence and in the annual aggregate. And we will look at the excess liability policy that sits on top of this in the next slide. In respect of legal liability limits, there are no hard and fast rules on the levels that should be carried, but there is a need to comply with various regulations, such as EC 785/2004, which is an EU regulation on insurance requirements for air carriers and aircraft operators. 9/11 led to the cancellation of all war liability coverage, and after a review, cover was reinstated for a maximum level of $50 million for third-party bodily injury and property damage claims for an additional premium. This level of $50 million was not enough to satisfy leasing and financing requirements and keep the world's fleets flying. The solution was provided by a combination of government indemnity schemes and the commercial insurance market. The government indemnity schemes were put in place by governments such as the USA that saw an attack on one of their airlines as an attack on the country itself. After a number of years, legal liability markets started to increase the war liability sublimit from $50 million to anywhere up to $250 million. The excess war third-party liability limit operates on top of this sublimit and is currently provided by the commercial insurance market in almost all jurisdictions. There are very few government indemnity schemes that remain in place. There are limits available of up to $1 billion any one occurrence and $2 billion in the aggregate. So we saw the standard market deductibles under the hull all risks policy in an earlier slide. An airline may decide to buy a separate policy to cover the gap between this market standard deductible per aircraft type under the hull all risks policy and their own risk appetite. This will apply to partial losses and will operate alongside the hull all risks policy, and therefore the main exclusions will be as per the hull all risks policy. Sometimes the deductible will be driven by a lessor, financier or owner. A deductible is essentially a credit risk for the aircraft owner. If there is a partial loss while the aircraft is in the custody of the airline remains responsible for paying that part of the repair cost. If they were to go bankrupt while the aircraft was in the shop, then it is possible that the lessor or financier would end up having to pay the repair cost up to the level of the deductible in order to repair their asset and get custody of it. I've seen deductibles brought down as low as $50,000. If you're dealing with aircraft leasing or financing, you have likely heard of Aviation 67B. So what is it? Back in the olden days, prior to delivery and the attachment of an aircraft to the policy, and I'd like to say I wasn't in the market in the olden days, underwriters needed to read and review the hard copy of an entire lease or financing document, some running to hundreds of sheets of paper. This was impractical and meant delays to deliveries when physical documents sat waiting on underwriters' desks. In the early 90s, brokers and insurers got together to solve this problem and created the Aviation 67 standard market endorsement wording. However, it had not incorporated concerns from financiers and lessors, nor did version A. Version B did and became widely accepted in the leasing and financing communities. The purpose of Aviation 67B is to recognise the interests of financiers and lessors in the ownership of the aircraft and give them various standardised rights and entitlements under the insurance for that aircraft. Before we move on to the next section, I want to make a distinction between an insurance policy and an insurance certificate. The policy is representative of all the terms, conditions, premiums and warranties that the insurer and insured have agreed. Lessors are unlikely to ever see a policy document for their lessees. What we do see are the certificates, which are intended to be a summary of the relevant insurance terms that apply to the specific aircraft in question. While a lot of the policy terms will apply on a blanket basis across the airline's fleet, such as policy limits, sublimits, and aggregate limits, the certificate will evidence the terms that apply to the aircraft, such as agreed value and effective date for the cover. Looking at a typical lessor or bank aviation insurance policy, it has two main elements: contingent cover and possess cover. Contingent cover is additional protection for the lessor in the event that the primary airline policy should fail to respond or the lessee has failed to adequately insure the risks. Some examples of why the primary policy might fail are non-payment of premium. While a lessor should be given notice before cover is withdrawn due to non-payment of premium, an airline could potentially continue flying despite the cover ceasing. Another reason it might fail is errors and omissions by the lessee's insurance broker. Financiers have to trust certificates issued are correct and reflect the insurance arranged. An example here would be that an airline's policy is extended, but agreement has not been obtained from all underwriters under the programme, and the insurance broker has erroneously confirmed that full coverage is in effect. If a loss then was to occur and certain underwriters refuse to pay the claim, they could cite the absence of a valid contract. And another reason that it might fail to cover is inadequate liability insurance. It is possible that a lessor could be exposed to liability claims once the operator's liability policy limit has been reached and exhausted. This contingent insurance cover provides additional comfort for lessors. Most of these policies will have a condition that the existence of the policy is not disclosed to lessees, so that they do not somehow rely on it to respond and do something untoward in respect of their own policy. The other major element is possess cover. Cover for aircraft and spares in the care, custody and control of the lessor or their agents, or in the course of repossession. There will be certain additional elements of coverage that a lessor or bank policy would typically contain. Technical records restoration would cover costs arising from the loss or damage to records or the suspected loss or damage to records. This would typically cover the cost of a technical audit and maintenance to restore, update, or reconstitute records and the associated positioning or test flights. Repossession expenses would indemnify the lessor or bank in respect of expenses incurred in the repossession or attempted repossession of aircraft or spares. This usually covers the cost of flight crew, fuel, airport dues, and navigation charges during the course of the flight up to and prior to landing in a safe location. It is important to view an aviation insurance program as a long-term investment designed to protect against a worst-case scenario. There are some insurance buyers that take the view that if they spend $1 million in premiums, then success is recouping $1.2 million in claims in the following year. This view is short-sighted and is likely to be penalised by underwriters. Another reason that lessors buy an insurance program is to cover off the issue of negligent entrustment. Negligent entrustment is a cause of action in tort law that arises where one party is held liable for negligence because they negligently provided another party with a dangerous instrumentality, and the entrusted party caused injury to a third party with that instrumentality. This legal duty is particularly evident when an employer hires an employee for an occupation that could be hazardous to the public. For example, if a pizza restaurant hires a delivery driver with bad eyesight and a poor driving record, they may be liable for an accident caused by the delivery driver. This is a photograph of a real accident in the US. The pizza driver involved sustained a head injury, but despite the still bleeding head wound, completed the pizza delivery before going to the hospital for treatment, a model of commitment to the job. There have been quite a few attempts over the years to try and pursue lessors after major aircraft losses. However, none have yet succeeded. This photograph shows wreckage from a loss in June 2009 of a Yemenia Airways A310, which was destroyed when it struck the water and crashed offshore from the Comoros, with 142 passengers and 11 crew on board. One passenger survived. The aircraft was owned and leased by ILFC. After aircraft losses, there are often attempts to file suit in the US, as the awards are so much larger and negligent entrustment is a US law concept. In this instance, the passengers were mostly Cormoran or French nationals. There were also Canadians, Ethiopians, Indonesians, Moroccans, Palestinians, Filipinos, and Yemenis on board. So there was no direct connection to the US through the passengers' nationalities. However, the ILFC head office was in California. The family members of the deceased filed suit against ILFC in California, alleging the company was negligent in leasing the aircraft to Yemenia Airways. Even when it is clear that the lessor or financing entity plays no part in managing or operating the aircraft, efforts continue to be made to pull the lessor or financier into litigation, especially in US courts, as they can be viewed as the deep pockets behind an aircraft. Lessors and financiers will often fight against being brought into the US courts with the concept of, forgive my Latin pronunciation, forum non conveniens. Non-convenes. Spoliation of evidence is the intentional, reckless, or negligent withholding, hiding, altering, fabricating, or destroying of evidence relevant to a legal proceeding. On April 19th, 2000, Air Philippines Flight 541, with 131 passengers and crew on board, was approaching Davao City Airport on Samal Island, and another aircraft was on the runway. Flight 541 began to circle in low clouds, waiting for the plane on the ground to move off the runway. As it circled, it hit the side of a mountain with the loss of all those on board. The aircraft was a 22-year-old Boeing 737, formerly owned by Southwest Airlines and bought by AAR Aircraft and Engine Group in Illinois. AAR had leased the aircraft to Air Philippines in January 1999 and sold the aircraft in April 1999 to Fleet Business Credit Corp, which became a division of Bank of America and assigned Fleet its rights under the lease. A lawsuit against AAR and Fleet was filed in Cook County Circuit Court, and following an argument presented for forum non-conveniens, including an appeal, it stayed there. The case was settled in November 2007 for $165 million, which the plaintiff's counsel said amounted to about $1.5 million per victim. But lawyers for the families say no one will ever know what caused the crash, because it's alleged that parts of the Mangle plane were dumped in a pit and buried in concrete before they could be examined by independent experts. This case highlights the need to preserve evidence in the event of a loss. Judges will take a very harsh view of anyone found guilty of spoliation. Given this negligent entrustment case was settled, there was speculation that if it had been instead adjudicated, there would have been substantial sums awarded against the lessor. As the wreckage of the disaster was purportedly concealed in concrete, an argument was raised by the claimants that the lessor acted in bad faith and negligently allowed the wreckage to be buried, disallowing further examination and thereby opening the door for punitive damages. There will always be geopolitical concerns and threats that underwriters are monitoring and responding to. However, in the last 2 years, they've had an immediate and direct effect on aviation insurance. Russia's invasion of Ukraine led to sanctions impacting insurance and leasing, and also to changes in all insurance cover types, but most significantly hull war. In March 2022, there were sanctions which prohibited the broking and provision of insurance and reinsurance related to certain goods, which included aircraft. This meant jurisdictions subject to these sanctions, such as the UK, could not provide insurance under a Russian airline program, which in turn meant the primary policies would not be in effect. There were also sanctions on leasing aircraft to Russia, which meant EU, UK, and US lessors needed to terminate their leases to Russian airlines and repossess their aircraft before the date that those sanctions took effect. As we saw, this wasn't wholly successful, with a number of aircraft trapped in Russia. As a result, there was an immediate response from the hull war market, which issued their 7-day notice period to exclude cover for certain countries. As airline and lessor programs renewed, these exclusions became embedded in the renewed policies. The most commonly excluded were Russia, Ukraine, Crimea, and Belarus. Moldova has also been included in this list from time to time. In summer of 2022, after that Russian invasion of Ukraine, there was also concern around China and Taiwan in terms of a similar event taking place there at some point, and exposures were examined closely at the renewal of each airline or lessor fleet for compositions in terms of Chinese and Taiwanese airlines. There are a number of other regions that hull war underwriters have concern over, and this will vary based on the current geopolitical tensions. Most recently, the conflict in the Middle East flared in October of 2023, with active engagements in Israel, Gaza, and Lebanon. From an aviation insurance perspective, this has led to notices of cancellation for airlines domiciled in Israel and Lebanon. Under hull war coverage, there is a notice period of 7 days, and that is 7 days notice to change rates and/or terms. If the changes are not accepted by the insured, the cover is cancelled. These notices of cancellations are commonly referred to as NOCs. In this instance, the market has issued 7 days notice to either reduce that 7 days to 24 or 48 hours, or to exclude cover for Israel and/or Lebanon. As a first step, the insurance market will engage with their airline clients flying into Israel and/or Lebanon to understand the risk assessment the airline has carried out and the resulting risk mitigation activities. What is worth noting is that the bar has been lowered for issuing notice in the market. In this instance, NOCs were issued for Lebanon before there were any active hostilities in Lebanon. Aside from geographical exclusions, the changes that I've seen for airline cover over the last 18 to 24 months have been a reduction in aggregate limits for hull war coverage. As I mentioned earlier in the presentation, an aggregate limit is a cap on the overall claims within a policy period, and most airline operators will have a hull war aggregate on their policy. The old way of calculating these was 3 times the maximum aircraft value, or the aggregate of the top 3 valued aircraft in an airline fleet, but this increased over the soft market in aviation as an add-on. This would be an example of coverage creep. In a soft market, when the competition is high and rates are low, underwriters will often improve various terms and conditions rather than reduce rates any further. The second type of change are sublimits being imposed on various types of cover, such as confiscation, or for various certain jurisdictions. In particular, the cover provided by LSW 555D, paragraph 1E, which covers confiscation, nationalization, seizure, restraint, detention, appropriation, requisition for title, or use by or under the order of any government, whether civil, military, or de facto, or public or local authority. I've seen various iterations of this being excluded entirely, being excluded for certain jurisdictions, or sublimited for certain jurisdictions. Another change is the addition of language that imposes a condition or conditions to reduce or limit cover, such as an exclusion for damage arising directly out of hostilities between Russia and Ukraine. Spares deductibles have increased for some airline fleets, and rates are generally up compared to 2021. Looking at changes that have impacted lessor aviation renewals, these are much the same as those that airlines have seen: reduction in aggregate limits for hull war coverage, sublimits imposed for various types of cover, such as confiscation or for certain jurisdictions, and the addition of language that imposes a condition or conditions to reduce or limit cover. More specific to lessor policies are aggregate limits being imposed on hull all risks policies, or an exclusion for theft imposed on hull all risk policies, or the removal or reduced limits for other so-called add-on coverages, such as technical records restoration, repossession expenses, and risk bursaries. Much like the hull war aggregate increases for airlines, these add-ons would have crept in over the course of the soft market with coverage creep. Similarly, lessors will have seen rate increases since 2021, but much larger increases than the airlines would have suffered. So, as we've seen over the last few slides, there's been quite a few iterations of cover changes presented in lessee certificates over the last 18 months. The question is, does your lease allow aircraft operators to flex this cover? Now, more than ever, the careful review of airline insurance certificates should be a top priority for every lessor to ensure compliance with the terms of lease documents. I would give the example of hull war aggregates. These were of little concern to most lessors prior to 2022, as the levels were generally so high that they were more than adequate. However, with the erosion of these limits over the last 18 to 24 months, there is a possibility that the total agreed values for leased aircraft for one lessor will not be sufficiently covered by the aggregate limit. In addition, lessors should be interrogating the security behind the airline insurance programs to ensure that they are of sufficient standing. If that isn't something that the lessor is allowed to do as part of the core lease terms, then changes should be made to the lease template. This is something to be mindful of in lease negotiations, ensuring that lease language allows the lessor to insist on full insurance coverage, however they define that, to ensure protection for them, financing, and other third parties. From the lessor standpoint, they often have their own financing facilities in place. When they carry out insurance compliance, they are performing it to check compliance with the lease, but also to check compliance with the terms of those financing facilities. While the insurance terms in the lease and the financing should ideally be aligned, this is not always the case. This means there is a possibility that if a lease allows an airline operator to flex their cover, in turn, those changes to cover could potentially lead to a breach of a financial covenant. If there is a gap between what the lease requires and the financing requires, would the lessor need their own aviation insurance policy to step in to cover that gap? If so, do insurers know, because they do not like surprises? A lessee's insurance policy is primary and should be relied upon to protect you and your asset. But in order to ensure that you're getting the maximum and correct protection, you need close scrutiny of the insurance terms going into deals and transaction documents. Then from there, compliance can be achieved through robust procedures with careful attention to detail. Drawing the comparison to sunscreen, the careful drafting and enforcement of insurance terms will help prevent major pain. I'm hopeful that this is not what you all look like on the other side of the screens, and that I haven't left you more confused than before I started. But we do have some time now to answer questions, and I'll try and get through as many as I can in the next 11 minutes before I potentially have to drop off.
That's excellent. Thank you very much, Andrea. We do have a number of questions, so let's get straight into it. The first question, I think, is has a number of elements to it, but let's just stick to the main one. Will insurance cover the residual value loss of an aircraft that continues or through the life of the aircraft? I suppose this is more focused on residual value insurance, which is a topic you covered today.
Yeah, I didn't go into RVI residual value insurance in any great depth. Most of us in the insurance world, well, the real insurance nerds amongst us in leasing, don't believe in the value of residual value insurance. And the main reason being that there are a lot of return conditions that are attached to it, a lot of technical conditions that require a threshold to be met before payment is made on that residual value. I've only ever seen it put in place by banks when they're financing aircraft, that as a belt and braces approach to protecting the value of their asset, they will insist on RVI. It's quite expensive, and if any lessor out there is being asked for it, I would suggest that they push the cost back to the financier who's requesting it, because I don't see a value for a lessor in that.
Okay, fantastic. Thank you. I think I'll read the next question as it was provided. I understand that certain jurisdictions limit overseas reinsured percent for aircraft under their jurisdiction. They give the example of Uzbekistan limits their airlines to only a maximum of 95% reinsurance from overseas reinsurers. Besides securing fleet insurance in general, is there any other way an aircraft owner or lessor can ensure they have a maximum reinsurance percentage from the lessees?
That comes down to your lease negotiations and your lease language. If you won't, local legislation and regulations are going to change over time, so you can't always predict, particularly if you're putting a 12-year lease in place, what kind of restrictions are going to be in place over the course of all of those 12 years. And yes, things do change dramatically. India, over the course of the years, has dramatically reduced the levels of retention that they require in the country, and they've taken a very protectionist view to their insurance. So the best thing that you can do is make sure that you have the best possible language in your lease, so you get the maximum level of reinsurance possible for each of those airlines that you're signing up in your leases. It is difficult. It is a difficult scenario. It's one I've had a lot of difficulty with over the years. But there are, making sure that you have something in your lease that does require a minimum will at least help some way.
Okay, fantastic. Thank you. The next question is, the most common incident is ground handling events that you just mentioned. With a hole in an aircraft that's a result of ground handling incident, whose insurance applies, the ground handler or the aircraft related hull insurance?
You'd be coming at that from an airline insurance perspective rather than leasing. So this is a step removed from my source of knowledge, but my guess would be the airline would claim under their own policy, and then the airline's insurers would subrogate then against the ground handling companies, depending on who is at fault, and they would pursue whoever is responsible for that. So if it was the ground handling company's fault, then their insurance will step in to reimburse the airline's insurance. It's much like having a car accident where there's two cars involved. Oftentimes somebody will just get their own car repaired, and behind the scenes the insurance companies will work out the details based on who is at fault for that accident.
Right. The next question is, how can an engine lessor financier protect themselves and get comfortable with the cession rights in insurance certificates to ensure proper coverage?
The cession rights when it comes to engines. I assume this means that we're looking at one part of an entire piece of machinery that needs to be covered as a whole. I suppose one of the best things that you can do is make sure that you've got an engine gross-up clause on your aircraft insurance. So an engine gross-up clause will make sure that if a third-party engine is fitted to an aircraft, the value of the aircraft will increase such that the engine agreed value is added on top, and the engine lessor will be paid directly for their engine, and the aircraft owner will be paid directly for their aircraft. So it should lead to less disagreement as to who is getting which part of the settlement.
Okay, thank you. You described negligent entrustment as a particular concern for aircraft owners and lessors. Can this risk be insured against?
It is something that the legal liability and a lessor's own aviation insurance policy will help to protect against. So there will be defence costs in there, although an airline's primary policy might be the one that you want to use to defend against in the event of a negligent entrustment case, your own aviation policy will also respond to it as well. So it will depend on whether the aircraft is leased at the time, or whether it's under runoff cover, or whether you're looking for your own policy to respond directly.
Okay, thank you. The next question is, could recent events extend the hard market period? I
would expect, certainly for Hull War, that it is going to extend it. I I think underwriters have been waiting for an excuse for a long time to increase rates. COVID wasn't enough of a reason for the airlines to have additional. In fact, if anything, insurers were under pressure to return premiums because airlines weren't flying their aircraft. So the Russian sanctions were an ideal time for underwriters to point to something that was an external event that would require them to increase rates, despite the fact that they haven't, as far as I'm aware, paid out any claims.
Okay. The next question is, what is the role of a loss adjuster?
The loss adjuster will be appointed by an insurance company in the event of a loss. And what they really are there to do is to investigate the circumstances of the loss. Again, if there is a fault to be found, perhaps another entity like a ground handling entity, and they will find the fault of the loss, or perhaps it's a part that was traced back and an issue with the part. And they will also provide the loss estimate, and they will coordinate the response on behalf of the insurers on the programme, collecting funds from the market and making sure that the release forms then are sent across to the owners and financiers and anybody else who is a contract party on a certificate.
Thank you. The next, we do have a number of questions, so I'll go as quick as I can here. Can you discuss the benefits of getting runoff insurance from a purchaser for an off-lease aircraft?
For an off-lease aircraft, I think really, again, once your name is involved in the chain of ownership and financing, you really need to make sure that you're getting runoff cover, regardless of whether the aircraft is on or off lease. If it's not going to operate into the future, your risk is obviously substantially reduced because there is less chance of an incident, which then a claim could arise from, which your name could theoretically be attached to the litigation surrounding. It's still prudent to try to get that runoff cover, and that should be the opening position, to try to get it. And if you can't get it, then maybe that's a commercial decision to surrender the request at some point in the negotiation.
Okay. Next question is, what is the most common insurance gap weakness that you see in lessor insurance policies?
I mean, I haven't read a huge number of lessor insurance policies, only the ones for the companies that I've worked in and some of my clients over the course of this year. I mean, they're fairly standard, and most prudent insurance buyers will get something that has a fairly common level of coverage. I think it really will come down to the limits and making sure that the limits that you're buying are sufficient and keeping pace with your fleet as it grows. Or conversely, if your fleet was to contract, maybe you've sold off a large part of your portfolio, have you reduced the limits because you don't want to overpay on your premium then? But I don't think that there's any major gaps right now. You know, the brokers that most people are engaging, they're sophisticated, they're based out of London, they know what they're doing, they're well experienced. They're not going to leave an obvious gap in a policy. I think maybe it will come down to a perspective on coverage, what the leasing community would like to see covered by insurance, as opposed to what is available in the market and that underwriters are willing to cover, which is more of an existential question as opposed to one of, you know, it's one of supply and demand rather than one of what is currently being put into policies.
Okay. The next question, the person begins by thanking you for the presentation. They say, can you please further expand on what are the options for an airline which receives a notice of cancellation from their insurers? Taking the example of El Al, what would they do if all insurers refuse to include Israel in geographical coverage? What would they be able, at least be able to insure aircraft on the ground in Israel?
Yeah, I mean, first of all, the broker should have been at the face of this issue. And once an underwriter has said they want to issue a notice, then the broker should have coordinated the response on behalf of the airline, provided any information that the airline, that the insurers wanted to see from the airline, whether that be, as I said, risk mitigation activities, maybe storage plans in other countries, maybe a change of routes, maybe a change of flight paths. So the broker really needs to step in first and foremost to try and hold off a notice of cancellation for as long as possible. If then underwriters can't get comfortable with where the airline is at that stage, that's the point at which notices of cancellations are going to be issued. That could be just for something as simple as additional premium, and that could be a huge premium that is so large that it's just a route worth operating. It could be a question of, so it's up to the airline themselves and the broker to try and work within the limits of what the insurers will allow. If there is a complete blanket exclusion and it's midterm in the policy, it might be possible to change the composition of the program and change underwriters. It could be a very difficult task, though, to go out and, if one underwriter has said that they won't cover, it is highly likely that a lot of the other market will follow the same position. There are options, but it may come down to a change in routes for the airline. It may come down to storing your aircraft for a period of time, or a restriction in routing.
Okay, now look, Andrea, we have had some Wi-Fi problems. Your screen was freezing there for a moment. So I think we do have 4 remaining questions, and I'm sorry to those who've put their questions forward that we haven't got to them. But I think whilst we do have a good Wi-Fi, just 1 or 2 very last questions.
Well, I will at least stop my video and see if that helps anyway, and that might keep us going a little longer.
Okay, well, I'm happy to do that if you are. The next question, just make sure I've got the right one. Can you please briefly explain reinsurance?
Okay, so reinsurance is insurance of the insurance. So the way that it is commonly placed is insurers will need to get reinsurance to smooth
I think we are running into problems here, Andrea. I think we may need to wrap up the call. I'd like you just to come back for a second if the internet's going to oblige.
that. Sorry, get all here.
Andrea, yeah, look, we are, the Wi-Fi is dropping out. So I think with all due respects, I think we should wrap things up. I want to thank everybody for joining us. We've had a fantastic audience, and in particular, I'm delighted with Andrea's presentation. Andrea, for people to contact you, I assume they can find you via your website, is that right?
Consulting.ie, and I'm on LinkedIn if anybody wants to reach out.
Okay, fantastic. Look, thank you very much, Andrea, for your time. We thank the audience for joining us, and we look forward to further learning labs in the coming weeks and months. Thank you. Take care.